So I'll get started. I'm going to go really broad and then really narrow, and if there's stuff that you want me to spend more time on, just slow me down and ask me questions and I'll spend more time on it. This is really broad, so I just went and stole some data from Takubo and tried to make it look pretty a couple of ways. So I was shocked. I only get data from Cambridge on like the 162 endowments, but there's a lot of endowments I've never heard of. 809 post-secondary educational institutions, which have almost 2/3 of $1 trillion of value in the U.S. Median endowments 142, with the average is almost $1 billion, so it's a pretty skewed sample. Not surprisingly, the majority of this is with the top 22 endowments. The little bar chart is the highest endowment. Any guesses as to, you wouldn't have heard of the school probably. Harvard. Harvard's on the left. Then there's the median, that little insignificant thing in the middle there is the median, and then the lowest. I was surprised the lowest still had $3 million. Maybe there's a point where they don't go below it. It was a music school here in New York. I forget the name. Year-to-year changes. Also distribution-wise, sort of split them into thirds. The top 10 is about a third. The next 50 are about a third, and then the next, I'm not that good at math, 749 are also about a third. So probably split up about like individual wealth in the country as well. Year-to-year changes are not just about market return, so I bet St. John's had a really great bump this year. By the way, thank you to St. John's and the Dean for holding this and for inviting me here, and thank you very much to Betty and Anna for hosting this and many, many others. I've been an FMA for 30 years now, almost to the day. I went back and looked, and I joined around the end of May in '89, so 30 years here. Anyway, so one school had a 74% change in its market value. I thought, wow, that's a really big return. And then I remembered, oh yeah, you know, if you have a really big development year, that'll pop your number up quite a lot if you don't spend it. So they must have had a big money raise. There's a small community college just a few miles from my home that had a 35% drop in its endowment last year, while the market was up, I don't know, a gazillion% or something like that. So it's not my community college, or I might have inquired or might have wondered why I voted for the people I did to run it, but it's the one in the next county over, and I have no idea what's going on there. They're probably shutting down. Although I didn't know community colleges did that. Endowment per student, which is kind of really the way to think about this stuff, is $42,000 median. It's not so bad. It's not going to take care of the students for life. And that $42,000 endowment's not going to cover all their expenses or anything. The average is 3.5 times higher. The high, we'll play a little guessing game, the high, which is in New York City, is 11 million. There's an endowment that has $11 million of endowment per student in New York City. Any idea? Not far from there. Rockefeller, thank you. Yes, so the name kind of gives it away, but I don't know, there must be something weird about the way they count, but I think they have a couple hundred medical students and they have a massive endowment, and so I don't know if that's a legitimate ratio. There are a few endowments that have just over $1,000 per student, which makes me wonder why bother, but to each their own. Typically, the way that endowments work is there's a payout rate, which is usually set, it's always set by the board, usually at about 5% per year, not dissimilar to foundations. And the average endowment dollars, so go up to wherever my average was, somewhere up there. The average endowment dollars are providing almost $40 million a year support to if there was an average university, I'm not using median but average there, or $7,000 of support per student per year. So it's a significant amount of money. It's maybe not earth-shattering and it's not covering all the expenses, but it's a pretty big deal. There's usually, this is interesting, there's usually some sort of smoothing rule. So it's not 5% of the endowment, it's 5% of some historical number about the endowment. So for us, it's the year ago number, and then 12 more numbers that are each a quarter older than that. So 1 to 4 years, they average all those, and then it smooths the amount that the university gets. But what does that do to the risk that you're taking with that corpus? It makes it really extreme. Because if the market goes down, for 4 quarters, you're going to completely ignore the fact that the market went down and keep drawing off of the old total. And so what happened is a lot of endowments came very close to collapse after the financial crisis because the smoothing rule, which smoothed income, a flow, did nothing to smooth the stock, which basically eviscerated the future flows and also destroyed their liquidity, although it did keep the university afloat during a difficult time. So anyway, it's a big risk issue, but it's really hard to make the sale on that and try to get people to change because the CFOs are always concerned about income. They don't think about wealth very much. I use the University of Chicago here just because I have good numbers on it. So let me start where the pictures are. So what is the University of Chicago? We're a little bit different from other schools. I'll explain why in a second. But what I tried to do as an ex-finance professor, and I just tried to roughly guess, because I didn't have time to run any models and I don't have enough, I don't know the cost of capital on a lot of this anyway, what all these business lines are worth. So undergrads, I know that one, that's negative. Undergraduate has a negative net present value. However, when you combine it with development, it's worth something. So you shouldn't say that, oh, it's stupid to have an undergraduate program. It's basically your raison d'etre, and the way you get paid for that is with gifts down the road. So way over on the right, I've got gifts. I don't know if our gifts are worth $4 billion in net present value. That's one of my, I'll talk about it later, that's one of my research ideas for folks. I don't know that anyone's ever looked at that, and it's an incredibly, incredibly important. It's far more important than 90% of the finance research that I see that's out there today, and there's no one working on this ever. So it'd be really cool to understand what the net present value of development is and the beta of development for reasons that I'll get into in a second. Graduate programs at Chicago probably worth a little over $1 billion a year. The business school is pretty profitable. Law school to some extent, medical school less so. Grants, because we have 2 national labs, are probably worth about $500 million or so. It's sort of done as a nonprofit, so it's not worth a ton. Auxiliaries, that's supposed to be a bookstore. I don't know, $250 million, just a guess, if you could spin out or carve out all of our different auxiliary businesses, like the press and all that stuff. We have a hospital. If you look at the pie chart on the top, you say, oh, that thing on the bottom, that's going to be tuition. That's like the school. But if you look carefully, it's not. It's patient services, that big 49%, all of that. But so half the revenue is coming from the hospital. I don't know how to value a hospital, but it's just sort of looking at revenue and looking at other multiples. It's got to be at worth 3, and it's probably not worth more than $5 billion. The one thing I do know the value of, because I can count it, I can like lay the hundreds out and I can count them, is the endowment's worth $8 billion, because when I look on my financial statement, it says I've got $8 billion with different managers. It's the only thing I know how to value. So it's the biggest thing up there. It's not biggest in terms of revenue, because we parcel it out very slowly and carefully into the future. And also the margin on it's pretty good, like compared to a hospital. We make the money, we don't really spend anything to make it, and then we give it away at 5% a year. So how do we do that? Well, let's see. Let's look at, let me go up to the right first, and then I'll go down to sort of some of the deeper strategic goals. So here's the title. Here's where the title's from. So the green is the endowment. Anything I've got in green, they're up on the laser pointer. There we go. Up here, endowment payouts 11% of the revenue. And notice net, whoop, what did I do? Sorry. Okay. Net tuition and fees is about 10%. If you look at our actual statement over here, the revenue, the endowment payout's 505, and you shouldn't look at net tuition and fees, you should look at gross, but we discount tuition and fees pretty much like every other school at about 50%. I mean, on average, the big schools are all discounting tuition at, I forget how the numbers work, it's like 52% for freshmen and 46% for undergraduates overall. So the endowment is covering all the tuition assistance for all the students. That's one way to think about it. Which sounds awful to you all because you're not getting a penny of that. But it allows us to apply, the rest of the tuition to then pay for expenses on the other side. So going down to expenses, so here's where the title comes from, is the endowment payout is enough to pay pretty much for all the academic salaries. So that's nice. So maybe that's the way that in this room I should think about it. But when you're talking to regulators and government and policymakers and the press, it's definitely the one at the top. So we're basically, we got all this money so we can make it essentially free for our kids to come to school. Yeah, free. Whatever it costs half as much as it otherwise would. So, so what are the numbers you need to do this? So down here in the bottom, we think we have, oh boy, it's really hard not to throw open my mouth a little bit when I say this, but we have a 7.5% expected return in our endowment. That's what it says on the slide, so it must be right. If I tried to tell you how we got there, you would just laugh at me, so I'm just not going to go there. It's probably lower, but that creates problems because, well, you'll see why in a second. The payout rates, well, for us it's 5.5%. We're a little bit aggressive as a school, and I'll show you on the next slide, or maybe the slide after that, we're a little bit aggressive in a lot of dimensions. One of which is we're taking a lot more of our endowment out and using it. It's resulted in some good moves with respect to rankings, and strategically it's probably one of the best things we could have spent our money on during this time. We started during the financial crisis with a crazy high spend, and it worked. So I'm not being critical, it's just the reality. We spend a lot of money. And then here's the objectives for an endowment, and these are all kind of conflicting, is we want to preserve purchasing power, because the reason it's in the endowment is people specifically told us, do not spend this money today. I want this money for future generations, right? Well, anyone ever heard of the agency problem? I think we invented it in finance. I think some guy named Spence came up with the principal agent problem. Anyway, maybe a Nobel Prize or two for it. To me, 90% of finance is about the agency problem. I did not understand this as a professor at all. I started to understand it when I became an executive, and when I got deep into investing, that number's way low. 98% of finance is about the agency problem. And so there's way too little research about the agency problem. It's like, oh, a guy discovered it and publicized it and got a Nobel Prize, and now no one really knows what to do with it. There's so much that needs to be done with that in terms of coming up with incentive-compatible contracts, looking at where costs can be high for the agency problem getting in the way. And there's so many areas that that's important in. I run into it every day. So we need to preserve purchasing power, which is a problem, agency problem-wise, because all the people at the university aren't going to be around in 20 or 40 years, and that's what the endowment's for. They all want to spend the money today. So it creates an interesting tension, and we usually cheat towards the wrong direction because we're humans and we like to get what we want, which is now. We're supposed to maintain a stable spending stream, okay? But again, that creates a lot of dysfunction in terms of the risk of the overall asset base. We're supposed to finance key initiatives, growth, and so we want this expected return to be higher than the payout rate because we want to preserve purchasing power and we want to have some growth. And it shouldn't just be inflation. We should be having, like, maybe the gifts are going to take care of getting us more and more real spending purchasing power over the years, but at least without the gifts, we ought to be able to stay ahead of the inflation rate. Which at these numbers, we really can't. I don't know if the inflation rate is supposedly about 2%, but we all know it's not. And we are falling behind purchasing power-wise every year that I'm there. We're supposed to maintain the university's place and status among the world's leading research universities, which we've clearly been doing, and then some. And as I go through here, you'll see lots and lots of different agency problems. Okay, so we have this thing we call it, because people like to give names to things that have acronyms, we call it TEAM. It's Total Enterprise Asset Liability Management. We just ignore the liability, so it creates a nice word. And it's basically just pension thinking. It's just pension LDI brought over to the endowment side. And I guess I'll start with learning how to use this. All right, so I'll start with, we may be one of the few university endowments doing this. What do endowments usually do? Is they usually just chase returns. They usually say, hey, someone gave me a big pot of money, ours is $8 billion. So you walk into work, you're the new CIO, you're like, cool, I've got $8 billion. I'm the manager of an $8 billion hedge fund. That's even bigger than my old job. So what I'm gonna do is I'm just gonna make as much money as I can. Now, nothing sounds terribly wrong with that. Making money sounds like a wonderful thing. But when they do that, they may end up putting the university's actual existence at risk, depending on, I mean, you may have to take certain risks to do that, and maybe you don't think about those risks because you're just chasing returns. Why would you ever do this? It's the agency problem, right? No one ever becomes a hero for saving a university by losing 4% less than all the peers, half of which went underwater, and you've lost 4% less, which is like unbelievably difficult and heroic, and no one will ever write an article about you doing that. But if you make 4% more than everybody else, you get books, you're in the paper, you're a big hero, and so it's all about ego, and so that's the way we run it. Everybody runs endowments to chase returns, and they kind of want to take, it's like climbing, leapfrogging each other, taking more risk to get more return, which makes it a lot of fun. There's an issue, doesn't really relate to asset liability management, which is sometimes when I bring up risk management, I'm trying not to make this talk about risk management, but about endowments more broadly, but it's really hard to distinguish the two from our point of view, because we view those things as one and the same. I hear a lot of times that sort of, we're a long-term investor, we don't have to worry about risk. And I'm thinking about writing an article about, like, although I think Cliff Asness sort of already wrote an article a little bit like this, but about, you know, sort of the biggest lies in finance, and this would definitely be one of them. I don't know that we're long-term investors. Saying you're a long-term investor implies that you don't have any liabilities in the short term, and that you're just going to kind of wake up Rip Van Winkle style in 20 years or 40 years and say, hey, how's that endowment doing? Did you guys like quadruple the money? And I don't care how you got there. I don't care about the path it took. We're like completely path independent here, because that doesn't matter. But when we've got a spending rule and a smoothing rule, you can bet that the path matters, and it turns out we actually have very fixed liabilities. Each of you sitting here does not think of yourself as a fixed liability, but from the university, because you're a huge asset to the university. But in some sense, to the CFO, you're a fixed liability. You're just like a pension plan. You're a check that's got to be written every year. Worse than a pension plan, you want your check to go up every year. And unlike a pension plan, some of you are really young, and you might not ever leave until you die. So you've got the same end point as a pension plan, but you begin much, much earlier. You're like the worst pension plan ever in terms of risk. So you provide incredible benefits, and the university wouldn't exist without you, but you got to think about the liability side. There's a real inflation and fixed income liability over there that probably also relates to growth as well. So you're short growth, you're short inflation, you're kind of short fixed income in terms of what you need to do to balance out the books, so maybe you need to balance that off on the asset side. And we don't think about the endowment by itself, we think about all the other assets. So we think about the development office, talk about that in a second, the facilities, maybe your really long real estate, maybe a New York or Chicago university turns out to be really, really long real estate, or maybe you're doing sale and leasebacks and getting all fancy to try to work your way around that. Anyway, on the right-hand side, you've got debt, pensions, long-term contracts, which is a fancy, non-judgmental way of saying we have professors who are tenured in who are never going to not want their money. We also list that again down in compensation, financial aid. I mean, none of this stuff goes away, and then depreciation and interest, which you might have if you have debt, and I'll talk about debt in a second. Over here, we've got stuff like hospital income. Remember, we're a hospital, not a university, really. And so we've got a lot of risk already as a hospital. When we go to work, and we open the door on the university on Monday, and like try not to think about it, as we're opening the door, we've got as much risk as like 3 other universities put together before we even unlock our university. Then we open it up, and we got another whole university's worth of risk on top of the hospital. So we think about this as we try to put our risk appetite together, and well, I'll talk about the agency problem that creates in just a bit. We call our endowment TRIP, so I just lined that out at the top, but if I use the word TRIP on here, it just means the Chicago Endowment. So what we do is we try to figure out, I won't spend much more time on us, but it's a neat case study. For enterprise risk management, what we do, and you know, we have, I apologize for the silly red, yellow, and green, but when we're talking to boards and things like that, you can't quantify stuff too much, you have to make it a little simpler. So across a bunch of the different dimensions, I don't even have them all listed here, we have a lot of gift capacity. We have a growing, successful bunch of people that are hitting the prime of their lives, which wasn't true 20 years ago, and so we can probably take some risk. However, and here's that open research area again, what's the beta of gifts, right? So we know that people give maybe some portion of their wealth, and so if their wealth goes down, their giving is going to go down, so you might think, well, so I guess it's got a beta of like 1. Well, maybe not 1, because their wealth isn't just in stock, so maybe it's like their portfolio maybe gives us a beta of 0.6. However, the marginal inclination to give goes down a lot too when your income goes down. I remember personally, as I was going through '08, and like everybody else, kind of panicking, will Morgan Stanley go under? By the way, I've got great stories about that too. If you want to nail me down at lunch, I can tell you stories I can't tell you in front of a camera at lunchtime. I think that year probably I dialed back a little bit on charity, and it wasn't the only one. So beta, there's a lot of beta in gifts, and if that's true, and if gifts are really important to the future of your university like they are for us, because we're a very young school, we're not like Harvard or Yale, we're barely over 100 years old, and we've really only been in the big time with respect to giving. I think we're like on our 3rd capital campaign or 4th or something like that. We're really new to this. And so giving is probably a bigger thing than endowments in terms of our future, or at least it's of the same order of magnitude. So if there's a lot of beta there, maybe you don't want to take a ton of beta in your existing assets because there's so much beta in the net present value of your gifts. We'd love to see some work on that. We have a lot of leverage. I don't want to say how much leverage because we're in front of a microphone, but we have a lot of leverage. You wouldn't believe it if I told you how much leverage we have. And that's there for a reason. That's how we got through the financial crisis. We basically tried to leapfrog the competition by not doing anything operationally aside from the hospital during the financial crisis, and levering to fill the gap, and then basically hiring who we could from other people and starting up new programs, and that's kind of how we moved from a, whatever ranked school, 12th or something like that, to, I don't know if you, I don't even know which ranking I believe, but 4th or 9th or 6th or whatever, they're all kind of different, but it's been a huge leap in rankings in the last dozen years. We have a big hospital, talked about that a little bit. We've got a lot of risk already when we open up the door. Do we want to take a ton more risk with our endowment, given that we may have 3 or 4 times as much risk as a regular non-hospital-based university already? So Stanford, Johns Hopkins has the same kind of problem they've got to think about, and they like us, mostly ignore that problem. But we try to think about it as we're putting the risk framework together. I'll skip over. What we did after I got there is this is a short version of about 15 studies that I went through with our board of trustees over a 6-month period. And we tried to show them what the different risk drivers were, and then we asked them which ones they cared about. And so quantitatively, there was no question, the only one they really cared about, and the only one that really mattered, was global equity risk. It drives maybe 82, 83%, something like that, of the variability of our returns, of our value. And so you want to control that. They clearly wanted to control our relationship to this. They don't want the university relying on this thing we have no control over, so we wanted to target a certain amount of risk there. I think we're the only big school that actually targets beta on their risk. Most other schools use an asset allocation approach and don't really understand the overall risk that they have. And when I got there, our guys didn't understand how much risk they had either, but they knew that. That's why I got hired. They wanted someone to come in and try to make sense of all that so that they would understand how much risk they're taking, and so they could think about how much risk they wanted to take, which was a question no one had ever asked them before. It's kind of surprising for a big asset like that. A couple of secondary things. They were really keen on having a particular return appetite, which drives a lot of behavior, because what do you do if your people are telling you they want a certain amount of money and then you end up sinking into a low return environment? What do you tend to do? What's the obvious thing to do? You should go back to them and tell them you're in a low return environment, right? That's what you would do if something changed at work and you had to tell your dean that we've had an electromagnetic pulse. I can't do my research anymore because my computers don't work, and I'm going to be using an abacus now, and it's going to be slower, but I'm still going to get my paper out, right? But that's not what you do in the corporate world. You can't say that. You basically go back and you salute and you say, yes, boss. That's what we're going to do. And so now, in a return environment where no one can get 7.5% in the long run anymore, you got to do, I don't know, what do you do? Finance folks. Take more risk, right? take more risk, or come up with great new ideas, but wait a minute, shouldn't you have been doing that already? So you can't like pull out on them. But anyway, they're concerned about illiquidity risk because they saw a couple big universities who shall remain nameless but are really, really big, have their endowments nearly collapse because they ended up with too much illiquidity risk, too many projects in flight that were illiquid. And so we cut back a little bit to 35% illiquid target. They were concerned about leverage for a lot of obvious reasons from the, we don't have a name for it yet. There's a whole decade we've still not named. You know what we call it? We call it last decade. But in another year and a half, we're not going to be able to do that anymore. Anyway, from whatever the hell that decade was, a lot of leverage stories from that decade. And so our board said, we're not going to have any leverage. You're going to deal with the cash you've got, and that's one way of knowing that you're never going to, we're never going to see a Lehman Brothers situation with the Chicago Endowment. Makes sense. Another thing I'll talk about briefly, because it's so cool and I thought you'd like it, is short optionality premium and wrong way risk, or negative convexity, or nonlinear beta. And we offset that with a volatility allocation to actual volatility assets. I need a time. How are we doing on time?
We're a quarter to one, so
okay.
15 minutes.
All right. Bunch of other stuff that I tried to get them to care about, they just didn't care about. So we report it, we measure it, monitor it, and really don't pay a lot of attention to it. It's on a bunch of reports and no one ever looks at it. I had to do this slide because I can't talk about endowments without showing you what an endowment looks like. So there's a pie chart, but God, they're so boring. So for academics, I put together a cooler version of the pie chart, which is a bubble chart that's got the 10-year trailing return on the top, on the Y, and on the X is our beta. GEF's just global equity factors, what we call our beta. So you can see a more or less sensible relationship there with cash about where it should be. Fixed income, we've had declining interest rates, so you can't get... See, the problem with another behavioral finance / agency problem with behavioral finance is people are adaptive, they're backwards looking. So people look at this stuff and they're like, yeah, we'll make 6.5% in fixed income for the next decade because we just made 6.5% for the last decade. So of course, like, how can you tell me you're not going to make 6.5%? It's like, well, yeah, the whole reason you made 6.5% in the last decade is there's absolutely no way that you're going to get 6.5% in the next decade because interest rates completely cratered. And we're in a new monetary environment. Anyway, the thing that looks weird on here is that real estate and natural resources are way down here, which is disappointing. Maybe the risk isn't measured that well on them. Everything else kind of looks like it lines up reasonably well on some sort of a security market line, but
are they annualized, these numbers?
Sorry?
Are these annualized numbers or,
yep.
Or cumulative?
Annualized. Yeah, it's probably a little bit high, but it's what we made. Yeah, I mean, remember, 10 years is March 31st, 2009. March 9th, 2009 was when the S&P hit 666 minimum. So we started at the bottom, and yeah, this has been an insane, unbelievable market run, and we did quite a bit better than our benchmark. So, and the problem is looking at these numbers, so now we're in this really inflated, low return, inflated asset environment where people are saying, yeah, just do what you guys have been doing for the last 10 years because it's been super awesome. We want more of that. So what does that do? It makes us take crazy amounts of risk, which is sort of what we're moving to. We've moved from this very risk-based environment to one where we're starting to look more and more and more like our peers, which is the whole thing we were trying to get away from. Anyway, that's too much inside baseball. And so let's see, some cool wrinkles. I don't know if I want to cover too many of these. Maybe. So I'll cover two things. So one, there's been a little bit of work on this, but probably not enough because people just don't do much with it, is, so you see you've got a bunch of private equity funds, and you're trying to figure out what the beta is on those private equity funds. And you run the beta on the current quarter. These are quarterly. We get those numbers quarterly, unfortunately. I wish I had more data, but that's just how they come to us with quarterly valuations. They're private. No one buys or sells them. Someone just tells us what they're worth. And maybe they're not being honest about it. So then you throw in some lags, throw in some more quarters and some more quarters, and you find out, wow, the return depends somewhat on the current quarter's return, but it actually depends a lot more when you add these up on the previous quarters returns. So this little picture over here, which is too complicated to explain with just a tiny bit of time, is so I did an example where the market was up 11.2% and we produced I think it's 3.5% return. It was an actual quarter for March of 12. It's just something I used in explaining this stuff to our board. And each quarter you can try to sort of de-smooth, or you can try to smooth the public returns, or you can do the inverse of this and de-smooth our lagged private returns. And so we've come up with processes to do this, which are fairly simplistic. It's basically matrix or matrix inversion. It looks a lot like this thing down here at the bottom. And so, how is it that we only made 3.5% when the market was up 11.4? It's because, well, 2 quarters ago the market was down 15%. That was the Europe thing in 2011 that absolutely nobody remembers unless they were in Europe. But the market was down a lot, and that still affected returns going out. So the lagginess of private returns is an interesting point. I don't know that anyone outside of our industry finds it remarkably interesting, and maybe that's why there's not a lot of research on it. But it gets in our way of managing and working with data every day, because everything else we get daily data on. How can I do this one quickly? All right, when you do regressions, there's one thing you're going to learn from this, is don't ever do another monthly regression ever for the rest of your life. All right, and here's why. So whenever we do regressions, we run a thing called Mega Regressor, which we just coded up in VBA, and it takes us about 2 seconds instead of a regression, which probably takes you about a 1/4 second. But I got 1 3/4 seconds, I can spare it. So instead of running a regression, I run this, because I get 2016 regressions. Why the heck would I do that? Okay, so the way it starts is I run a daily regression, and that's that point right there. So what I'm regressing is our entire mapped return series. So I basically boil our entire portfolio down to a series of like 4,800 publicly returned things. It sort of has the closest correlation to our return series on a theoretical and a practical basis. And then I can work with that and do VARs and things like that people at sell-side firms can do. We had to build all this stuff from scratch. There's none of this stuff when we got there. All right, let's say when you run a 5-day regression, which I'm doing here, because maybe a 5-day regression gives you more information than a 1-day regression, because there's stuff out there that's lagged. Well, it turns out that's the case. There's 5 different ways to run a weekly regression. Everyone just runs from Friday to Friday, but why not you run a weekly regression Tuesday to Tuesday? What the heck's wrong with that? Right? I'll pay you Tuesday for a hamburger today. There's no one in here old enough to get that. All right, it's an old Popeye thing. Anyway, so there's 5 different ways to run, and so we just run them all. The computer doesn't care. It doesn't care if it's running a Tuesday to Tuesday. So when I get to a month, which is 21 days, in finance, not in calendars, there's 21 different regressions to run. So I'm going to ask you, so where's 21 at? I'm going to go up here. These two, the two at the top, what are they? What days are those? Where is it? 21. It's these 2 right there. So the 2 highest betas we get, what days are those? By the way, you can do this for almost any asset class.
Friday?
End of the month and the first day of the next month. Almost any country, almost any asset class, your betas are goosed. They're incorrect for the end of the month. I mean, they are what they are, but they're not that high for anywhere else in the cycle. Why is that? I don't know, anyone knows for sure, but there's a lot of, that'd be an interesting, fruitful thing to look at. I mean, academically, because a lot of people do, people still actually go work with monthly data, and they do so incorrectly, working with end-of-the-month numbers, which are completely bogus. So we got all these other ways to run monthly numbers, so we could just do them all and average them. It gives me way less standard error than just working with, why do I want to throw away all the other information that I've got in my daily series? So the other thing to see here is as you get further out and you do regressions that are 2 months and 3 months, the beta, it's increasing, which it shouldn't be. It should be level. So there's stuff that's not being captured in this daily data. So you can run betas on daily and even high frequency beta, and it's telling you something, but it's not telling you about the long-term return characteristics. So we have to kind of compromise between not having enough data, because if I go too far out here, there's not enough data, or having enough data to give me a completely incorrect answer. So we use the average of the 40 different 40-day, which is 2 month basically, regressions, and it gives us a pretty good estimate that's probably a reasonable balance. Anyway, that's just something I thought you'd you like, because I obviously made hundreds of mistakes in my career working with monthly data, which I have never made since, and so I just thought I'd throw that out there. Okay, all right, negative convexity. I won't hit all of this the next couple slides, but all endowments have negative convexity. So here's the universe of endowments, and it's the quarterly return on the Y, and on the X is the return on the S&P index. So you'd like to see a simple line that shows that the beta is, more or less non-stochastic, and it's not conditional on whether the market's up or down. You just got this linear relationship, because we're going to use beta to manage risk. So in fact, this chart was the first time I told my board they should fire me. So this is probably, I was maybe a year and a quarter in, it was about my 4th meeting. And I went to the board and I said, okay board, you've just agreed that we're going to manage our endowment to beta. So we're going to use a beta of 0.75. So when the market's up, maybe that beta is 0.75, maybe it's a little lower. I'll tell you right now it's going to be a little lower, but you probably don't care that much. You're not thinking about beta when the market's up. When the market's down 2 or 3%, the beta's probably about 0.75, and you don't care, and you shouldn't care. When the market's down 40%, you probably care what the beta was. And at that point, the beta's going to be 1. And so you should fire me for lying to you now. Or, together, we can do something about that. If we're going to use this measure, and it's a nonlinear measure that we're pretending is linear, we got to do something about that. We can either put our head in the sands, which is what most people do, or we can actually try to relinearize it. But you can see the nonlinearity here. Again, I did this not in the most professor-friendly way, because I should have just done the second order, which I actually had on the slide and took it off when I showed it to the board, because it has a significant second order, quadratic regression, negative statistic to it. But you can see it just as clearly that the beta on the up quarters is 0.47, and the beta on the down quarters is 0.72. This is for the whole endowment series, so there's nothing I've cooked in here, nothing about University of Chicago. This is just everything. Why is that? All right, this is, you're not supposed to be able to read this. It's just, here's the story. So the story is everything is lined up against beta being linear. There's no way you can run an endowment, no matter how hard you try, and have beta be linear. Because volatilities spike on you, correlations spike on you, you have no control over any of this. The betas spike as a result because they can't help themselves because the correlations have spiked. I've got a chart here showing carry in products, so this is just credit. So we invest in a lot of credit in this space. Oh, look at that, credit has negative convexity. Well, that's not a genius observation. We pay nonlinear fees. Boy, if none of this other stuff was right, down here in the little simple chart, we eat 100% of the losses and 80% of the gains because of our performance fee structure. Maybe that explains pretty much what was going on in that previous picture without having to talk about this other stuff. We invest in hedge funds. What do hedge funds do? Hedge funds like to produce positive alpha. I have to make the air quotes because when I say the word alpha, because I'm not sure it exists in this respect, because you can see what they're doing is they're effectively engaging in strategies that are like selling put options. And what happens when you sell put options? You get to put money in your pocket. And if you want to call that money alpha, you can bamboozle your investors and make them think they're getting something for nothing. And then when the market's down 40%, your hedge fund's down 80%, you can just kind of run away and say things didn't work out and maybe open another hedge fund later. Agency problem again. So you get wrong way risk. So you end up with this, you really want this green line where you sort of level off and you don't lose too much when the market goes down, but all endowments have this, some version of this red line, which is pretty tough for us because we use beta to manage to. So all endowments have negative convexity or wrong way risk. You lose more than expected when the market's down. Our beta, we believe, for our down markets is 175% of our beta for our up markets before we do anything to fix it. I'm not going to go into what we did to fix it. We basically just bought a lot of positive volatility things that would help fill that gap, but that's not really the point of this. My last slide, I'll just kind of leave it with you. It's the one you might want to take a picture of. So my humble opinion is, I don't have many humble opinions, I've been told, but is that the endowment space has been largely unaffected by advanced finance research. beyond the standard industry stuff that you see in the CFA, excuse me, in accreditation bodies of knowledge without mentioning any particular ones. So the stuff that's made it into those tests, yeah, we got that down. Everything else, we're doing absolutely nothing with, all right? So now, here's an agency problem. As you're thinking about what to do research on, what if you did research on something that actually indirectly resulted in you getting more money?
How about that?
That would be pretty cool. So as an agency problem, you all should be doing more work on endowments, not less work. So I applaud you all for not falling victim to the agency problem. However, this is a pretty fruitful area. So obvious areas to dig into. The agency problem, behavioral finance. Obviously people are covering behavioral finance right and left, but there's a lot of interesting case studies in the endowment space and the asset owner space you could talk about. Active investing, there's a space that's being researched, but there's still a lot of debate, and the debate isn't much more informed than sort of efficient markets, passive investing, anomalies, and so it's been that way for like 40 years now. And I don't know what else to tell you to do, but active investing is still a big, it's what we do. At the University of Chicago, think about this, at the University of Chicago, we use active investing to run our endowment. I'll just let that sit out there. Private investing, no one looks at private investing except people that are studying venture capital, and they're not the right people to look at this. It's really hardcore asset pricing people that need to be looking at this and figuring out what the return series on this, what the empirical bits of that look like. Universities, what are their utility functions? What are you trying to do with the university? We think that we understand the university's risk appetite and utility function, which is why we do this team approach, this total asset liability matching type approach. But even with all the work we did, we don't know what the utility function of the university is, or other organizations. So ours is not to maximize shareholder value. But I don't see a lot of work on that. The whole aspect of being a long-term investor, what's that mean? Here's some other more specific things that are just kind of cute little things that aren't really big picture, which means they're probably easier to model research on. Evaluating the lagged return structure of private funds investment returns. There's some old work by Edleson on this and some newer work by Woodward on this. There's not a lot else. So, and most people don't do this particular thing very well in practice. Valuation of market beta for future gifts. Here's a big one. Maybe I should have put it up top. Should strategic asset allocations change with market conditions? We take this from academic finance. We take the concept of a strategic asset allocation from the optimal point on the efficient frontier. That's basically where it came from, right? And then it becomes a sacred thing that we never fuss with. But there was all this research back in the mostly 80s and 90s about, the changing opportunity set, how you should change investments. So this has sort of been done from an academic standpoint, but absolutely none of it is being used in practice, which means I think there's still more work to be done. Here's a neat one, rebalancing. I didn't mention that before. We rebalance at endowments. If you think about the dynamics of that, it means that what are we doing? We make return because we're buying low, increasing our beta when the market's going down, and selling high, reducing our beta when the market's going up. Or if I change beta to delta, and you know anything about derivatives, you can see I've just outlined the payoff diagram of a short put option payoff. And we call that alpha. People actually talk about the alpha from rebalancing. No one's ever really made that, other than a cute throwaway line that I use in a lot of speeches. No one's ever really done that and studied that. Actually, if I wrote papers, I could have done this one because I did the work on it. But about a quarter of our alpha is just short put option premium from rebalancing. And we can talk about other stuff at lunch if